Here's 5 best ETFs that pay monthly dividends. Dividends are amazing if you want some passive income to eventually live off of dividends or to pay off some bills like your mortgage, that dream vacation you've always wanted to take, or maybe that midlife crisis sports car. Most dividend ETFs pay a dividend every single quarter, so 4 times per year. Some popular names like SCHD, VYM, and DGRO do just this. However, monthly dividend ETFs pay a dividend every single month or 12 times per year. So you have a more reliable and stable stream of dividend income to hopefully enjoy for the rest of your dividend investing journey. In this video, I'm going to go over a complete breakdown of 5 of the best ETFs that pay out a dividend every single month. So let's get started. The first ETF is JEPI, the JP Morgan Equity Premium Income ETF. JEPI receives a 4-star Morningstar rating, including a bronze medalist rating by Morningstar, which is really solid and quite impressive for this high monthly dividend paying ETF. The goal of JEPI is to deliver monthly dividend income with equity market exposure with less volatility. How this is done is by JEPI's portfolio managers with over 60 years of combined expertise in the investing world, where they write or sell out of the money call options on the S&P 500 index, and the result is a very attractive dividend yield, one that is going to be way higher compared to others in similar asset classes. JEPI's current dividend yield is around 7% with an expense ratio of 0.35%. Some of JEPI's top holdings are Progressive Corp, Train Technologies, Meta Platforms, Southern Company, MasterCard, and AbbVie. JEPI's top sectors are exposed to technology, healthcare, industrials, and financials. JEPI's dividend growth has been very solid since 2020, with a slight decline overall in 2023. According to Seeking Alpha, JEPI has an A- for its risk grade for having a low standard deviation and low volatility, which is great because JEPI is keeping its promise to investors for having both high dividend income as well as low volatility. The monthly dividends of JEPI have overall been pretty consistent for this dividend ETF and has been able to trend upward in its overall capital appreciation compared to investing in the S&P 500 ETF like VU, so it's a very solid choice. The second ETF is JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. The goal of JEPQ is to deliver monthly dividends with Nasdaq 100 exposure and less volatility. So if something like the Invesco QQQ or QQQM ETF is something that might be way too volatile and risky for you, then JEPQ might be an ETF that you should take a very close look at and do further research. JEPQ is ran by lead portfolio manager Hamilton Rainier with over 3 decades of investing experience, where they write or sell out of the money call options on the Nasdaq 100 index, and the result is a very high dividend yield that's going to be one of the highest in my opinion compared to other assets. The current dividend yield of JEPQ sits at around 9%, which is absolutely insane and great if you want to live off of dividends as fast as possible and retire off of this ETF. Just like JEPI, the expense ratio for JEPQ is exactly 0.35%. And similar to tech-focused ETFs, JEPQ's top holdings are Microsoft, Apple, Nvidia, Amazon, Meta Platforms, and Google. JEPQ's top sectors pretty much mirror the Nasdaq 100 of mostly technology, followed by a way lower holding to communication and then consumer cyclical. JEPQ hasn't been around for too long, but it does have some positive dividend growth, which is very nice to see. According to Seeking Alpha, JEPQ has a risk grade of a B for having a little bit of a higher standard deviation and volatility. However, it's going to be way less risky and less volatile than the QQQ by Invesco, which has a C- risk grade and a way higher volatility percent than JEPQ, and has been able to keep up with and even beat other great ETFs, like it has beaten the QQQ, SCHD, and VU over the last 3 years, so it's a very good ETF if you want exposure to technology stocks while collecting a very high dividend along the way. ETF number 3 is DGRO Amplify CWP Enhanced Dividend Income ETF. Why invest in DGRO? Well, it's comprised of high quality dividend-oriented stocks with a history of dividend growth, along with covered calls on these individual stocks, so you do have income potential. DGRO allows the portfolio managers to identify risks and opportunities, as well as to act on these decisions in real time, so you have active management. Finally, DGRO's dividend and option income allow the fund to have a lower share price volatility versus the overall market during times of a broad-based market decline, so the benefit of course, lower volatility. This strategy is managed by DGRO sub-advisor Capital Wealth Planning CWP and even receives a 5-star Morningstar rating, so it's a very reputable and qualified fund to be on this list. The current dividend yield of DGRO sits at around 4.4%, which is going to be way higher than your famous SCHD and other quarterly paying dividend famous ETFs. The expense ratio for DGRO is 0.56%, a little bit on the higher side for my liking, but that's okay. Some of DGRO's top holdings are United Health, Visa, Home Depot, Microsoft, and Procter & Gamble. DGRO's top sectors are very diversified to financials, healthcare, information technology, industrials, and consumer discretionary. DGRO's dividend growth has been very stable and flattening since its peak in 2019. According to Seeking Alpha, DGRO has a risk grade for having a lower volatility, lower standard deviation, and not as much turnover as other ETFs like JEPI or JEPQ on our list. The monthly dividends of DGRO have been very consistent and stable for this dividend ETF and has had amazing returns that have kept up very closely with the S&P 500 ETF VOO over the years. DGRO can be a great choice if you want those dividend grower stocks, a relatively balanced sector allocation, a very wise screening allocation for those stocks, as well as a covered call strategy, which is how DGRO pays that above average and high dividend yield. I want to thank Moomoo for sponsoring this portion of the video. Now, one of the best ways to start investing in dividend ETFs is on Moomoo. Moomoo is a free investing app where you can trade stocks, ETFs, and options. There are $0 commissions and $0 contract fees for stock and equity options, plus access to a very large amount of data, including dividend information and news to help you become a more knowledgeable dividend investor. For example, if I type in a monthly dividend ETF on Moomoo, it shows information like on the dividend section that provides definitions and the basics of dividends, how many times the dividend gets paid every year, and a cool chart about the ETF's dividends, all completely free. And how you could be receiving all this value is by clicking the link in the description of this video or in the pinned comment, and you can start your investing journey today with up to 15 free stocks when making a qualified deposit. Moomoo is also giving new users 8.1% APY interest on your uninvested cash for a limited time. So go ahead and click the link in the description to take advantage of these awesome promotions and experience the power of Moomoo. ETF number 4 on our list is SPY NEOS S&P 500 High Income ETF. SPY provides monthly dividend income in a very tax-efficient manner with the potential of upside appreciation in rising markets. SPY has 3 main benefits, the first being that it has high dividend income from its data-driven call option strategy, the second being it's actively managed and seeks to take advantage of tax loss harvesting opportunities, and lastly for upside capture in rising equity markets. The current dividend yield of SPY sits at well over 11%, so in the double digits, which is going to be the very highest so far, and if dividends are your thing, then this might be the ETF for you. The expense ratio for SPY is 0.68%, Definitely on the higher end of things, but that's going to be the price you pay for those high double-digit yield dividends. Some of SPY's top holdings are Microsoft, Apple, Nvidia, Meta Platforms, Amazon, and Google. SPY's top sectors pretty much mirror the S&P 500, with information technology, financials, healthcare, consumer cyclical, and communications being very notable holdings. SPY's dividend growth has shot up increasingly since its inception in 2022, only because it has been inception on the tail end of that year, so that's why. According to Seeking Alpha, SPY has an A- for its risk grade since it has a lower standard deviation, less concentration to its top holdings, low volatility, and very low turnover compared to other great covered call ETFs. The monthly dividends of SPY have been without a doubt the most consistent and the most stable for a super high paying dividend ETF, so if you want a really reliable and yet high paying and stable dividend fund, then this might be the ETF for you. And not only that, but SPY still manages to rise and increase values of the market just like the S&P 500, all while paying that high juicy dividend along the way. Coming in at number 5 is SPHD, Invesco S&P 500 High Dividend Low Volatility ETF. Just like its name, SPHD has 50 stocks that are traded on the S&P 500 index that have historically had high dividend yields as well as low volatility. SPHD's current dividend yield sits at around 3.5%, which isn't too shabby at all. On the bright side, it does have one of the lowest expense ratios of 0.3%. Some of SPHD's top holdings are Crown Castle, Verizon, Altria, AT&T, Vici Properties, and Bristol & Myers. SPHD's top sectors are going to be non-tech focused industries, so most people do have technology stocks or ETFs in their portfolio, so this is going to be a great one if you want that diversification and exposure to great sectors like utilities, consumer defensive, real estate, healthcare, and energy, which are going to be sectors that not a lot of people have in their portfolio. SPHD's dividend growth has been very solid with the longest track record and the most reliable so far on our list. According to Seeking Alpha, SPHD has a risk grade of a C+ because of a higher standard deviation and high turnover, but that's going to be totally normal because it's aligned with this strategy of only 50 stocks. The monthly dividends of SPHD have been very consistent and stable, kind of like SPY, which is going to be a great bonus for this fund, as well as the returns of over 9% annually over the last 10 years and over 8% annually over the last 5 years. If you guys like this video, please give it a like because this Q puppy did. Now right here is going to be a video on how much JEPQ you should buy if you are a JEPQ investor. And right here is going to be a very great video on some of the best quarterly paying dividend ETFs. Now hopefully you guys have a great rest of your day, continue to crush in the stock market, and take it easy. Peace.